Gents, let's get to your stock picks for today. Mark, what are you hanging your hat on today?
Yes, I'm picking Absa. So I think that the next set of results, we're going to see the credit loss ratio start to improve, so less losses. I think that the June was the peak of the cycle, the credit loss cycle. And then we're expecting interest rates to come down. Inflation's a bit lower. Wage growth hasn't been too bad, so there's a bit more added impetus to the economy, which means I think sort of 12 months out, the loan growth will be slightly better for the banks. And Absa's been really hammered quite hard after Jason Quinn left. They didn't signal well to the market what was happening in their loan book in December, but they tried to rectify that with a call with the analysts and a trading update. So I think that this set of results maybe not that exciting, but I think the prospects for the group are quite good, and you really are not paying much for it. I mean, you're paying less than book value, 0.9 times book value. It's paying over 8% dividend yield, and then you get a bit of earnings growth and a re-rating in the stock as well. So I think it's a good time to buy Absa.
All right, JP, what are you banking on?
A bank. I'm also choosing a bank.
Okay.
A European bank, an Italian bank called UniCredit. It's one of the biggest Italian banks, and very similar to what Mark just explained. It's also a bank that they fixed their loan book. They're trading at 0.9 times book, but their ROEs are now substantially higher than the cost of equity. So that would imply you can justify a price to book ratio well in excess of the book value, not a discount. It's trading at a 6 PE and the dividend yield above 6%. And I think why European banking investors have got this misconception about the fair value of a lot of European banks is because rates have been so low. Like I said, since 2008, rates have been abnormally low. And you had some banking issues a year ago in the US. But the US banking system is very similar to Europe. In the US, a consumer can fix their home loan for 10 years. So the bank must take the risk. In Europe, like in South Africa, if the reference rate moves, you as the consumer needs to pay more. So the banks don't take that risk, the interest rate risk on long-term loans. So that is why I like the European banking sector, and I like UniCredit, cheap and good quality.
All right, thanks so much for your analysis today, gents. Really appreciate it. That is all for Stock Watch tonight. Thanks to our guest, Pierre Verster from Protea Capital Management and Mark du Toit from Oyster Catcher Investments. Up next, The Close. Stay watching.